Blind Squirrel Macro, the pod. This is our usual companion to the weekly newsletter. Commodities this week. I thought you could do with a break from tariff chat. Anyway, I'm coming to you on the morning of Monday the 20th of January, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links. Plenty in there this week, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. First up, as ever, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent. Talk to a financial advisor. Now, in case you hadn't been paying attention, commodities have been enjoying a pretty robust start to 2025. Not fart or Trump coin style, but certainly enough to keep a few grumpy old men with a preference for atoms over bits quite happy. The squirrel stands guilty as charged. He's content, but on edge. The fact that these commodities have come out of the gate so strong with the backdrop of a US dollar that's been rampaging since October of last year is a major contributor to my nervousness. It's just not supposed to work like that traditionally. Markets are braced for the volatility that will inevitably arrive this week with the new Trump administration. Bidding up the dollar would indeed be a logical move for investors looking to hedge or speculate on the prospect of significant and early action on the tariff front. For what it's worth, the theory goes that major exporters will seek to weaken their currencies to partially offset the economic impact of those tariffs. But we no longer live in normal times. Now, the poly market is matching bets in a number of tariff-related markets. It's interesting to see that speculators on this platform would appear to be fading the more aggressive potential trade-related moves. Seems odd, given the volume of rhetoric on the topic, both from the transition team and from the concerned leaders of America's largest trading partners. As at midnight Eastern time last Friday, only a 22% chance that Trump follows through on his 25% tariffs for Mexico and Canada were priced on the platform. Seems a bit low. Opinion and gambling is one thing, but those with real skin in the game are clearly taking decisive action. Any oil refinery boss in the northern states of the US are certainly not going to be taking any chances about wearing that 25% premium at best or an embargo at worst when it comes to his or her key cost input, West Canadian Select crude oil. He's filling his tanks now. Investors in Canadian energy companies are certainly not taking the risk and have been actively voting with their feet. The basket of the squirrel's favourite, but not currently owned, Canadian oil and gas companies has underperformed the XOP, the popular US E&P ETF, by more than 15% since the election. That's real money. In the metals market, we've seen some frenzied short covering in the gold and silver futures pits. The shorts have zero interest in taking the remote, who on earth knows, risk of having to pay a markup at expiry if forced to cross the US frontier in order to satisfy physical delivery of their bars at the COMEX designated depositories in New York. I've added an hourly chart of front-month gold and silver futures relative to spot since November 7th in the show notes. This chart plots a steeply rising path of that futures premium, a premium that's accelerated in recent days as the shorts are squeezed higher. Now, target, timing and level of any tariffs are frankly a guessing game at the moment. The squirrel is firmly in watch and wait mode when it comes to risk assets, and when it comes to commodities, both the buy and the sell buttons are firmly locked in the desk drawer until we get some further clarity. This week's piece is not intended to be the Rodent's 2025 commodity outlook. There is, however, plenty to think about. First, it feels too early to position for how any potential trade wars might impact broad economic activity, and specifically how they might alter the behavior of China, the world's largest consumer of commodities. And then there's the other types of war. As of January 2025, there are approximately 20 significant kinetic wars or armed conflicts taking place around the world. According to the Council for Foreign Relations, about 25% of the world's population lives in conflict-affected countries, either direct or as a result of forced migration. Those tragic LA fires and that polar vortex freeze that we're already witnessing this year are a salutary reminder that we're also in a period of extreme weather volatility, with major potential consequences for numerous energy and agricultural markets. There's going to be plenty of noise in the commodity markets of 2025. Yes, I know that friends don't let friends trade the weather or trade geopolitics, but it may just be one of those years. Now, I've had plenty of questions in the past few weeks about how to add commodity exposure to portfolios. Of course, it's been working. In a world in which there's an ETF for almost anything, I think there was an expectation that the squirrel might simply point folk in the direction of some kind of one-stop shop product to add commodity exposure with the click of a mouse. The trouble with most ETFs is that they are only as good as the often flawed index they replicate, or in the case of active ETFs, the portfolio manager that they employ. Now, this is almost non-existent in commodity world outside of the trend followers. Regular readers will know that this squirrel is borderline obsessed on the topic of ETF and index construction. There is, of course, a backstory. By coincidence, last week I was forwarded a video celebrating the 25th anniversary of the launch of the Tracker Fund of Hong Kong, or TRAC for short. This was the deal that took an unsuspecting 20-something rodent to Asia for the first time back in 1999. Back then, most of the deal team for TRAC thought that the IPO of a Hang Seng Index ETF would never manage to find broad appeal with investors. We were hopelessly wrong. The power of retail incentives, these were discounts and bonus shares, and the healthy thirst of the few index ARBs and hedge funds that managed to successfully run the gauntlet of TRAC's institutional allocation process ensured that the deal was a complete blowout. We bankers obviously tried to take the credit anyway. I still have a framed copy of the TRAC retail offer launch ad in my office. There's a picture of it in the cover art of the notes. Now, one of the reasons that a young squirrel had been tagged to relocate to Hong Kong to work on this deal, which turned out into an ETF launch, was the fact that I was one of the few Barings bankers at the time that had any familiarity with this new product. We all knew that the Hong Kong Monetary Authority wanted to exit its stake in Hong Kong equities via a passive route, rather than sell stakes in individual companies in a piecemeal and inevitably political fashion. Frankly, the team's hope was that we'd be able to change their minds. And to do that, at least one person on the deal team needed to sound half credible on the ETF product in question. Now, the squirrel's sort of credibility stemmed from his work on a thing called Project Time Bomb, the restructuring of BEMIT, the Barings Emerging Markets Investment Trust. Project Time Bomb was christened by BEMIT's chairman, the late and really rather brilliant City of London grandee Anthony Lernis. Time Bomb was BEMIT spelt backwards, if you ignore the OMB bit. Well, the name tickled Anthony's impish sense of humour, so he went with it. BEMIT was a closed-end mutual fund designed to track the total return of the Barings Emerging Market Index. This was an index that was ultimately acquired by the FTSE Group in 2000. BEMIT was trading at a steep discount to NAV, and the 1990s trust-butting versions of Bose-Weinstein were calling for the fund's liquidation. Anthony was keen to explore whether or not we could restructure BEMIT into one of those clever spider things. Now, he was of course not referring to arachnids, but rather to SPDR, or the Standard & Poor's Depository Receipt, which had been launched a few years earlier in 1993 with less than $7 million worth of assets. Yes, that's million with an M. Now, we know this this spider, well, we know it much more familiarly these days as the giant SPY ETF, with its billions of dollars under management. The reason that BEMIT was angering the trustbusters was not just that the funds was trading at a wide discount to NAV, i.e. the value of its underlying shares. BEMIT's NAV itself was also struggling to track BEMI, its underlying index, a universe of emerging market stocks across 20 markets from Santiago to Seoul that were both hard to access, often requiring local foreign institutional IDs, and expensive to trade. Now, you often hear wealth management disclaimers about indices referenced herein being uninvestable. Trust me, BEMI was one of those for real. We pounded the pavements of the City of London trying to find third-party brokers that might sign up as authorised dealers for our new EM Spider. But we couldn't even persuade our own equity traders at Barings to raise their hands. BEMI was simply too tough to trade. Which brings us back to commodities, and specifically commodity indices. The concept of a commodity index is not novel. The CRB, the Commodity Research Bureau, had established one back in 1957. It was a modest improvement on the paper and pencil version created by The Economist back in 1864. But these indices really only served as useful tools for economists, journalists, and the chatterati. They were wholly impractical for traders that were attempting to track them. Just as we've seen recently with Wall Street's co-option of crypto markets to create another table at the casino, we wrote about that just before Christmas, the 1990s saw Goldman Sachs and the late AIG create investable indices, these days known as the GSCI and the BCOM or Bloomberg Commodity Index, over which they could launch investment products and start collecting fees and commissions. The compilation philosophy behind these indices indexed heavily, on investability. This meant that the compilers focused on the largest commodities in terms of production and futures liquidity, without giving any consideration to the demand side, or rather future expected demand side of the equation. Anyway, the winners of the commodity index game have clearly been established. BCOM and GSCI's focus on liquidity metrics above all else allowed for the listing of index futures on those indices and has ensured that they've attracted the greatest volume of benchmarked financial products with all those associated fees. Meanwhile, the first mover CRB's inclusion of a larger spread of agricultural contracts, including some of the less liquid ones, allowed it to participate, even though it rebalances that index monthly in the great right tail moves in what the squirrel likes to call the great 2023-24 breakfast commodity revolution. That is cocoa, coffee, and that favourite for all fans of trading places, frozen concentrated orange juice. As a result, CRB managed to comprehensively outperform its more closely followed cousins over the past 5 years. Now, it's worth noting that one of the principal attractions of commodity investing is exposure to precisely these types of tail events. The major trend moves are what delivers the bulk of commodity returns over time. You have to be a participant, but almost by definition, you're less likely to encounter those types of extreme moves in the largest and most liquid commodity markets, where the chance of a major supply-demand mismatch is less likely outside of a crisis. As it is, most investors that are looking for commodity exposure via these indices as a portfolio diversifier and inflation hedge risk finding themselves just taking an outsized bet on energy prices. Of course, oil dominates the inflation basket of today and of the last century, but by way of example, most of the themes for the future that we discuss in here, from AI data center growth to the energy transition, point in the direction of explosive copper demand. Now, both BCOM and GSCI have copper weightings of around a measly 5%. That feels pretty low an exposure to this rodent, and it's only this low because copper futures are insufficiently liquid. The next problem for owners of products tracking these indices relates to the trading practices of the futures market, as well as the shape of the futures curve for individual commodities. Notwithstanding what I've said earlier, billions of dollars of collective investment assets track the leading GSCI and BCOM indices, and in so doing, advertise their flow to the wolves of Wall Street. These indices roll their positions from one contract to the next in a highly transparent fashion. This is a gift for the arbitrage community and represents the constant erosion of returns for indexed investors. The index compilers are forced to buy superior front-month liquidity. After all, they have licenses to sell to those asset-hungry ETF and UCITS sponsors to focus on those contracts and ignore the shape of the individual futures curves. I guess here we need a quick refresher on backwardation, contango, and roll yield. If these are alien concepts to you, the charts in the notes will really help. For trades in backwardated futures contracts like oil, the roll effect is positive, as rollers benefit from a sell high, buy low effect. However, the roll effect is not great news for those many other futures curves that are in contango, where selling low and buying high creates the opposite effect and erodes returns. Notwithstanding all of the above, the squirrel believes that having raw exposure to commodities, not just to the equities of the companies that produce, process and sell them, makes sense as we live in these times of inflation volatility. But I think you can do way better than owning an ETF or UCITS fund benchmarked to the BCom or the GSCI. These are not the trading sardines you are looking for. In section 2 of the paid letter this week, I break down one rodent's approach in detail. We also discuss how this approach is factored into our new bushy multi-asset ETF portfolio. This feels like another great excuse to support my work by becoming a paid subscriber at blindsquirrelmacro.com. You can also find me on Twitter at squirrelmacro and on Blue Sky at blindsquirrel. Thanks again for listening. Please do spread the word. Ratings and reviews would be very cool too. Squirrel out.